Scott, good morning. Investors need to be ready for climate governance changes.
Peter, good morning. Yeah, as you and Trudy were just saying, this is going to be a big deal. Now, let's put the ideology and even the politics of climate change aside. There are going to be rules. There are going to be changes that impact investors. Trudy's already talked about coal in particular and other fossil fuels. And this is the real challenge. Even as an investor, if you take the view that this is all a hoax, it doesn't matter, any of that stuff, but the government still changed the rules and you need to be ready for it. If you believe the science, and I think we should, then you equally need to be ready for it. And so as investors, this is one of those big, I don't want to say existential risk, it sounds a bit over the top, but this is one of the big impacts on your investments that is really going to matter over the next 3, 5 and 10 years. If you're going to be ready for what governments may do, whether that's carbon taxes, banning stuff, stranded assets, the whole lot. If you're not thinking about it already, you really should be. And this IPCC report really should be focusing the mind on what you want in your portfolio moving forward.
All right, Suncorp's financial year earnings, meanwhile, Scott, jumped 43%. So how are the other banks looking?
Yeah, some stunning results. Well, particularly Commonwealth Bank from tomorrow, and the other banks following there out of the cycle. We'll see CBA on Wednesday. This is a stunning report for a whole lot of reasons, Pete, but particularly because Suncorp's taking the opportunity now, kind of 18 months after the pandemic started, to empty its balance sheet. It held a lot of cash because, firstly, it wanted to. Secondly, because the banking regulator, APRA, said it needed to. And this time around, I think we're seeing, well, if that's a buyback, a special dividend, an increase in the dividends, and that profit gain largely coming from write-backs of provisions they'd previously taken. So this is to some degree the back to normal earnings announcement. In the middle of lockdowns across much of Australia, that's probably, I wouldn't say aggressive, but it's certainly hopeful, it's optimistic. We all hope that's the case, of course. And if it is, it should be good news for bank shareholders right across the board moving forward.
Okay, and buy now, pay later. We do talk about this a bit, Scott. It's a great topic of conversation, but it's heating up as Klarna cuts fees.
It is, and this is, well, we talk about it because everyone else is talking about
That's
it. The
right.
growth, the march of Afterpay is phenomenal. Klarna is the Swedish business, part owned by Commonwealth Bank of Australia. It has 700 merchants in Australia, apparently, compared to Afterpay's 35,000. And if that sounds like a big difference, it is. And so Klarna is basically cutting merchant fees from the CBA for 6 months, while if merchants sign up to the Klarna buy now, pay later service. Either it's a heating up of competition and maybe some concern for other players that margins will be under pressure, or more likely, perhaps, it's desperation by Klarna and CBA saying, look, 700 isn't enough. If we're going to genuinely make a dent in this space before the horse is bolted, and maybe it already has, now's the time to do something and get serious. But it really does show that competition is heating up. That's good news for consumers if you are using buy now, pay later responsibly. Bad news, of course, if you're not. But overall, I think a reminder that margins in this space are huge. Afterpay's fees between 4 and 6% for most merchants, compared to credit card fees of about 2%. So there is plenty of margin compression ahead if competition does heat up in this way.
Okay, Scott, appreciate it. Talk to you soon.